Welcome back, everyone. All right. Let me quickly, so topic is basically we're going to have a quick panel discussion here. And before we left off, we basically took input on things that you were interested in. So I'm well aware that we have that list right here. Just to be the slightest bit formal, I'll just reintroduce everyone. Shomit, Ghose, you heard from earlier. Robert Mitchell, you heard from yesterday in terms of crowdfunding. Olivier, Younes, you presented yesterday, am I right, at Skydeck. And so Ravi, Belani, you heard from briefly, but just earlier. And Lisa, Oshima here. So I think that's our one new introduction here. While everyone's got a different perspective in terms of accelerators, in terms of crowdfunding, in terms of institutional venture, and I'm going to say venture on your side as well. And you are taking an angel investor's perspective. So let me just start with, everyone's going to take a few minutes to give maybe their perspective on probably just what is their viewpoint. But I think, Ravi, why don't we first start off with a follow-on from the questions which you got. And I think I'm almost ready to dump this list and go with yours. So maybe what we'll do is repeat the question and give a little bit of your answers on each one of those. And I think you guys feel free to just pick up and add to any of these things, and then we'll come back to this list. We're very agile, obviously, here. So go ahead.
OK, that sounds good. And should I limit the questions to the ones that were accelerator focused? Or
limit. Let's see how it goes. Answer your favorite question first.
Well, OK, so I think there's one question about how do I become attractive to an accelerator? And there was a conjoined question, I think, around that. There's a bunch of questions around accelerators. I'll give you the quick overview of all the questions so you guys have it in your head on the accelerator side. So the accelerator-driven questions were, how do I make myself attractive to an accelerator? How is an accelerator different than a VC in terms of value add or what an accelerator does? The landscape of accelerators, how do you think about all the things that are out there? And how do you choose between accelerators that are vertically focused, that are focused on some space or specific approach, versus broad-based accelerators? So just as a theme, I think that was an interesting one. And then there's a question about how did I start the accelerator and my story behind Alchemist. But that's a little self-indulgent. But I can give that.
Yeah, so go ahead. Why don't you give your accelerator perspective and weave some of those things in.
OK. So it is a fantastic time to be a founder in this world, because you can do so much with so little. So everybody's heard of Moore's law, and this idea that every year and a half the density of transistors doubles for the same price point, which basically means that things get cheaper and you can do more with the same. So that has affected entrepreneurship, where today, literally $50,000 today can have you do what you did 10 years ago for $5 million. And that's just because of Moore's law. So before, you would have to spend $250,000 for an Oracle database. Sorry, it's OK. And today, you can literally get the full power and leverage of that as a service, where you pay a monthly fee to Amazon, and you create great instances on whatever you want. And that's created opportunities and challenges. The big opportunity is that now you don't need to raise a $5 million check to actually to change the world, to have real impact and effect on the world. And at the same time, the challenge is that there's a cacophony now of accelerators that have emerged, because basically it doesn't take as much capital to start an accelerator, and because they don't have to give up as large checks, there's a lot of noise. Now, it's fundamentally, I think, a great thing. It's almost like it's almost like college. There's a ton of universities in the United States, and that's a fantastic, beautiful thing that you have a ton of universities. But not all universities are UC Berkeley. Some you do have your, you will have your universities out there that aren't necessarily the best path forward. And the challenge is that if you look at the number, if the ultimate end game is to create a change the world company, and you have to define how you are measuring what that means for yourself. If that, and that's a critical question for you to answer. But if you're looking at it classically, which is, from a venture-backed perspective, the heuristic for change the world is creating what's called a unicorn, which is a company that's worth $1 billion, typically on average in 7 years. But within 4 to 10 years, building a company that you start today that's worth $1 billion. If you look at historically how many of those companies have been created, it's still relatively the same. It's basically around 4 a year. It's 4 startups a year that end up becoming worth $1 billion. So the dilemma on the VC side is, how do I find a unicorn? They're unicorn hunters, okay? And accelerators can provide a pathway to signal that you are a unicorn, but they can equally provide a pathway to signal that you're not, okay? Just like colleges can be signaling institutions that can be positive and negative things. And so accelerators, when you look at accelerators today, they serve a variety of functions, which I don't think is too dissimilar from universities. There's the one which is the branding function, which is really as a distribution model to the top funds. Are you approaching that accelerator as a precursor to a venture path? But then there's value-added functions, which are helping you actually with building out the business and thinking about the mentorship and the customers and the community that you're really joining when you're thinking about joining this accelerator. As with universities, okay, what I strongly recommend, and even as with VCs, what I strongly recommend is the best thing to do is to talk to the other founders that have gone through the program, okay? And to get clear on what your needs are. Because some accelerators are really optimized around different modalities. Some accelerators are branding tools that can actually be very accretive in terms of getting you into a top fund or getting you publicity, but not necessarily in terms of spending a lot of time. It's, there are accelerators that will have huge classes where they just don't have the time to spend on you. And then you also have certain accelerators that will be very focused on certain verticals, on certain approaches. And you have to decide if that's of interest to you. At Alchemist, we're very different because we focus on sales. So our accelerator is really driven by helping companies get customers. And then we also help optimize the fundraising path. The beautiful thing about the accelerator from a fundraising perspective is that it does create an auction effect where the VCs will bid on you. But we limit our class size. So we only have 13 companies that are an Alchemist. We don't take more. And we typically have 250 funds that come to the demo day. So the ratio of funds to companies is so high that we have a 2/3 funding rate. Okay, that's our strategy. But you should get those details whenever you're just thinking about.
How long is the program?
It's a 6-month program, which is
okay.
different than the typical. Most accelerators are 3 months.
Okay.
But you want to. The key thing is to talk to the other founders who have gone through the programs to understand, what their direct experience was, because there might be a disconnect between the marketing of an accelerator and what the reality is. Because there aren't that many barriers to entry to create them. There is a flight to quality, I think, where the best accelerators tend to get the best venture investors and the best support networks, and so there is that virtuous cycle.
So what are the main categories of how they can position? You said one was they can help you get a brand, and then there's particular areas. I think you said yours was kind of more sales focused.
Yeah, I think the heuristic how we think about it. So we think about it as really 4 dimensions of that we measure ourselves by. One is fundraising, and you should think about why you're joining the accelerator. For us, it's fundraising, sales, or traction, or distribution. Whatever the analog is for your business in terms of getting customers of various sorts. Mentorship. That's beyond just sales, but that's actually providing direct mentorship in how to develop as a CEO. And that can be functional mentorship. So we have 2 different types of mentors. We have coaches and experts. Coaches are generalists, and the experts are vertical specialists within UX, within engineering flows, within sales as well. And then community. Do you want to be joining a network or a community that's going to be paying dividends down the road? I would say that if you look at those 4 dimensions, a lot of the accelerators will have strengths along some and weaknesses along others, and you should think about what you want to do there.
And then I assume that some are more, like part of this industry or part of a different industry versus being, and then maybe some are just, all industries. Yeah,
so this is the question about being vertically focused or broad-based. And there are, I would say that all accelerators, even if they admit it or not, generally have some trade-off that they're making in their program that's going to be optimized for some outcome. Mm-hmm. So there are accelerators like YC, Y Combinator, or 500 Startups, which are these broad-driven accelerators. But really, if you look at YC and 500 Startups, they're hack-driven, product-centric, primarily consumer companies. So if it's a 3-month, it's a 3-month program, which is a very limited time. There's 84 companies in YC's last batch. And it's really optimized. The reason why people join YC is the network and sort of the branding from the fundraising perspective. But I don't think it's a significant duration. If you're an enterprise startup, I don't think YC is ideal because it doesn't give you the duration of the time. And this is obviously unbiased because I'm an alchemist. But the broader point is to think about the trade-offs that accelerator is making and what the pros and cons are. And I think there are benefits in, like 500 Startups is a broad-based accelerator, and there is some brand value in 500 Startups, but it's questionable, how distinctive the brand might be. But what you're tapping into is that network. But the trade-off is that you might not have as much individual attention or as much of a vertical focus on something else. If that's important to you, then you might want to gravitate towards a more vertically focused accelerator. At the end of the day, though, what I would encourage you to do is just talk to the founders that have gone through it and apply. It's just like college. Apply to many. You might have like some safeties. And then once you have choices, then grill them. Once you get multiple options, then choose. And there's a little bit of a balancing act on how to navigate that process. But yeah.
Okay.
Yeah.
All right. So I'm going to basically summarize what you're saying, which is basically you've provided an overview of the landscape, and then you've given some particular advice on how you should navigate that landscape in terms of talking to other founders and all these different choices that you've got. And overall, this is the perspective that you see on the kind of investment side. I'm trying to actually just glue it into the rest of it.
Yeah, I appreciate it. I appreciate you doing the hard work.
So just go with me on that.
Okay.
And so now what I'll do is I'll ask the same question, even though it's a completely different one, down the line. And so basically the version of this then becomes, what are you seeing these days in terms of perspective of people getting funded, and just kind of what trend, some examples, and obviously I think you're talking from a crowdfunding perspective.
Yeah, from the crowd.
Yeah, go ahead.
From the perspective of crowdfunding, hello again, first of all, everyone. Yesterday we sort of discussed the 2 basic types of crowdfunding that exist today. We've got the type that exists on Kickstarter, which is donation or perk-based or pre-sale crowdfunding, which is essentially crowdfunding where no equity is exchanging hands. And then the new type of crowdfunding, which came into being in the US with the Jobs Act in 2012, equity crowdfunding, where you could go on to a platform that looks very much like Kickstarter, and we all saw the demo of Seed Invest yesterday, and actually sell private shares of your company online. So though the Jobs Act passed in 2012, the first pieces of it went into effect about 8 or 9 months ago. So there's been some interesting lessons in that period of time, interesting use cases and models that have emerged. And the one thing that those of us in the industry were relieved to see and were concerned about was that a year ago, everyone was saying that any company that went through a round of crowdfunding would be toxic, that follow-on and professional investors would not want to get involved in these companies for a variety of reasons that we can talk about. But fortunately, in that last year or so, less than a year, and I referenced some research that we did, recently, looking at several hundred companies that had gone through various types of crowdfunding. And I misspoke last night, incidentally. I looked at my notes more carefully today. 28% within 3 months of closing their crowdfunding round had gone on to professional investment, whether it be angel investment or VCs.
Okay.
So that's a positive sign. So rather than these companies being toxic, their crowdfunding round is providing a degree of signaling to professional investors, and it's an opportunity for these companies to do product market fit, build a community, build a brand, and that's being looked at by professional investors.
Let me ask you the order of events a little bit. I want to connect these two conversations. Does crowdfunding happen first, then you go to look for an accelerator? Does it happen once you're already in the accelerator? Does it matter? Are they complementary, or is it two different paths? Some people would do one versus the other. How does this fit into all the other options?
Yeah, I think it's complementary. The use case that's emerging most frequently is it's very, very early stage rounds.
It's the earliest stuff what everyone here is talking about.
Yeah, the earliest rounds. The smallest tranche of dollars usually, particularly if you're talking about the Kickstarter type of crowdfunding, but even with equity crowdfunding, smaller tranches of money and early stage.
How much of this actually depends on your own network still? I mean, is it like you put something up for crowdfunding, is it still you're emailing everyone that you know? Is it just a vehicle to communicate to the people you already know, or is it really you're getting to people beyond that?
You are getting to people beyond that, but we're finding that most of the funds are coming from your first degree connection. So you're communicating via social media, but the people who are really contributing the most are that first degree.
Okay. Unless it's clarifying or super quick, I'm going to just try to keep going. All right. Okay. So do you want to pick up on the angel perspective then? What are you seeing? What's an investment thesis? Give us some view into what you see as an angel investor.
Sure. So I should just maybe introduce myself a little bit, because I think that'll help you understand what my investment thesis is. But I come from the perspective of someone who's been in mobile for a very long time. So I've seen mobile kind of rise to where it is today, back from early Nokia phones and Symbian and Java and Brew to now being predominantly iOS and Android, succeeding in the race. And so for me, most of the stuff that I invest in tends to have a mobile bent to it, which is actually getting easier and easier, because more and more that's where people are going first. But what I'm seeing a lot of is, from an angel investor's perspective, it tends to be that angels tend to be super well networked, and they tend to have access to a lot of entrepreneurs who have been around the industry for a while. So the kind of things that I typically invest in are either companies that are started by people that I know, or companies that are started by people who come highly recommended to me. So I rarely, as opposed to crowdfunding, I think, which could be, casual investor goes online seeking opportunity to invest in something interesting that kind of excites them, and they may invest in someone they don't know. I think angel investors typically tend to invest in either people that they know and or networks that they know. So it's a little less sort of stab in the dark and a little bit more, I think, calculated in terms of.
So if you're trying to navigate or get into a network such as this where people could invest, what advice do you have for people? How would they reach you in a way that would make sense to you, but also from, if you're not in the network, how do you actually get into it?
So that's a great question. I think one of the easiest ways to kind of get into that network is to look for angel groups. So there are groups of angel investors are just like anyone else. They're looking for deal flow. Any investor is looking for interesting deal flow. And so while I like to say I invest in people that I know and networks that I know, the reality is that I belong to an angel group, and I sometimes see things through that interest me, and someone in that group is bound to know the investor, or sorry, is bound to know the entrepreneur. So I think part of it is just familiarize yourself, especially if you're in the Bay Area. It's very easy to get to know a variety of different angel groups, and go to some of their events and just network with people. I think also meetups and other events that are focused on entrepreneurship are a fantastic way to meet people who are really interested in this. And so it's I'm not saying that when I say I invest in people that I know, I'm not saying that it takes me years of knowing these people before I'd invest in them. I'm just saying you need to kind of know what someone's stock is, who they are and where they come from, and have some faith that they're going to execute on their vision. And so part of that is, I think, going out and just getting to know a lot of different people and making sure you're investing in your own brand and building your own brand with the right kind of people.
Okay, great. Shomit, what are you seeing?
So speaking from from the traditional professional venture capital side, so I'd like to actually build on everything that Ravi and Robert and Lisa said, because what they say is exactly what's going on. What we see is a lot of noise out there, and what I mean by noise is that there's many companies that now can come to us for funding because they've been through an accelerator, they've got angel funding, they've got crowdfunding, and as Ravi remarked, it doesn't cost a lot of money to start a company. It doesn't cost a lot of money to start a company nowadays.
Right.
It's probably literally about 1/10 of what it used to be 10 or 15 years ago. So we're kind of in a buyer's bonanza because there are so many companies that will now come to us with a lot of validation points in place. Whereas 10 years ago, we wouldn't be seeing that many validation points because they couldn't actually start building them until they had the professional money coming in. So we're in a fortuitous situation because we've got the follow-on money that the companies are looking for, but it places the entrepreneurs in perhaps a disadvantaged situation because you're one of many companies that's coming and looking for venture funding.
Yeah, I think there's something like 60,000 companies or something like that.
The University of New Hampshire actually tracks this on an annual basis, the number of companies that get angel funding every year, and it's over 65,000 year in, year out. Okay, and you can compare that against the NVCA numbers, which is the National Venture Capital Association, and it's about 1,000 companies a year that get Series A funding.
Okay.
Yeah.
So
if you did that,
60-to-1 ratio here.
exactly. Yeah. So that means that you as an entrepreneur, you need to think about the fact that, hey, I may have a good idea, I may have built all these things, but there are a whole bunch of other people who are coming even to apply to an accelerator or trying to get crowdfunding or trying to get angel funding. There are a lot of people out there seeking the money, and certainly we see quite a bit of that.
Yeah, no, I don't want that to come across as depressing, basically. And so let me put the other side, just for fairness, let me put the other side to that story too, which is if there are a lot of things that are kind of in this angel world and not everything moves on, the other thing is that those things that do move on, they're going to be hiring and growing with people who have the skills, and the only places where those skills were being generated were where other people were trying to do similar things. So while you're in a race to be the leader, you're trying to be Facebook, it doesn't necessarily mean that you're not, if you weren't the one who did Facebook, it doesn't necessarily mean that you weren't generating the skills that would be very important to Facebook or, when that trend actually happens. So it's not like if you're not one of the 60, it's a loss. It's just you're not going to be the CEO of it.
Right.
But for that matter, you might actually get acquired by a Facebook or by a Google or by someone else because the arms race is on with regard to engineering talent.
Yeah, absolutely.
And so, it's interesting because I'm working with a lot of companies right now who have absolutely no plans of becoming the billion-dollar business. And what they really want is just to get acquired by Facebook, Google, or someone else. Yeah. And at $1 million to $2 million in your engineering head for an acqui-hire, if you've got a great set of engineers, it's kind of like a no-brainer.
It's a very important point. Once you guys raise
before you make this super extra important point,
yes.
I only want to give you data, which is Yahoo did 35 acquisitions last year, and almost all of them were of teams that were size like 4, the average acquisition size. Go ahead.
The only thing I want to bring up is that once you take in venture capital, once you get to the holy land of actually passing the moat and getting accepted in, you don't get a penny of that money until you pay back the venture capitalist. So even when people say I just raised $5 million, the reality is that $5 million is actually debt, effectively. That has to be paid back before a penny goes into that entrepreneur's pockets. And so in a weird way, the other silver lining to this dynamic is that if you do build a company out that is a very effective sword, it's easier to make money as an acquisition and have meaningful money without having the overlay of the venture capital burden, if that's your objective. If you're fine making like $2 or $3 million, and that would be truly fantastic for you, then you can build a company in that way. more easily today than you ever could.
Well, and I would argue also that a lot of entrepreneurs come to me with ideas and they say, oh, I want to build $1 billion business. And there's 15 or 20 companies in the same space. And I want to tell them they have no hope in hell of ever getting this $1 billion valuation. But they're like, oh, I'm going to raise like $20 million from this, that, or the other VC. Like, I'm sure they're going to love me. It's going to be great. And I say the same thing that Ravi said, which is, well, hang on a second. If you raise $20 million, that just means that you are going to have to go for 20 million times some massive return for those investors to be able to release you of your commitment to them. So the reality is that I remind people that in a few years of working at a very big company, you'll be lucky if you make $1 million. So if you take a risk and you are willing to take smaller risks and to finance this on your own for a little while, or to get some friends and family money or angel money, and buoy yourself to a point where you actually have proven that, hey, we'd make a great addition to this big team, getting a few $1 million in your pocket at the end of a 2-3 year investment is actually pretty good. And if you can keep doing that time and time again, you've actually made your big $10 million return pretty quickly.
I think what you're pointing out is that this may be the new R&D.
Right.
It's in everybody's house. And when there's a fit, it's just the new model of bringing you in.
Yeah.
So, Olivier. You are the investor with the international perspective here.
Mm-hmm.
Tell us what you're seeing.
So, just one word on my background, just to explain what I can provide you with. I've been a venture capitalist for 10 years, and 2 years ago I created my own company, which gives pieces of advice to VC through due diligences. So we're performing for the last 18 months an average of one to two due diligences for VCs. So we have quite a broad view and understanding of what interests at this very moment VCs in France, but more generally in Europe. So first of all, there's back to basics. I mean, what VCs are looking at this very moment is still, as you perfectly explained, first of all the market, then the team, and at the end of the day, the business model. And that's it. They're not looking for technologies for the sake of it. It's just one of the possible picket fences that a company can build in order to protect and to sustain the business model. But that's it. It's just one amongst others. So that's the very first point. And the second point I can share with you is that having given this, the VCs in Europe are just tackling the risk mitigation. So they are looking for first later stage company, even if their investment thesis that was bought by the LPs was at the very beginning early stage. They are looking for later stage company. That's the first point. The second point is they are looking for recurrent business models like SaaS, for instance, if you're considering IT. And the third point is that if they're considering life science, which is something we are sort of a specialization on, they're looking for two different things. Either it's not a very later stage company, and then they can invest in medical device, because this is quite a limited risk return couple, or they're still attracted to making some investment in drug discovery or drug delivery, and then they're looking for pre-IPO deals. And one of the due diligence we performed was with Wellington Partners, that is here, but investing in one of the largest store in France for Genticell. It's a papillomavirus company. $25 million were invested, and as a matter of fact, 6 months after this round, the company went public.
All right. Tell me a little bit about the density of people who are investing in Silicon Valley is very high. I'm assuming that the density is not as high. Do you have suggestions? What do you see in terms of how deals get done? Does it change the speed? What is the environment when you're somewhere else, and how do you navigate that environment versus the Silicon Valley environment?
Okay. If we focus in France versus Silicon Valley, then France is usually Paris and some of different spots, effectively, with high verticals, but basically it's quite centralized. As a matter of fact, for the last 5 years, entrepreneurship in France has been very popular and backed by public initiatives. So the Banque Publique d'Investissement, which is the sort of a state fund, claimed to invest around 5 to 7 billion euros per year for the coming years in the PE and VC industries. So that's done through, first of all, subscription to direct fund, and also to the ecosystem things like accelerators or incubators. So there is sort of a very high density, and now we have the problem of making the differences between high potential companies and weak companies, as there must be some kind of yield management when you're considering the management of incubators and accelerators. They have to create that cohort, that promotion. They have to disclose some quantity, and this is the main risk, because you are just using money in bad investments. So we are now, to some extent, approaching some of the issues that can be here seen at another scale, obviously, in the Silicon Valley, with a lot of entrepreneurs, very high, very easy to claim to be entrepreneurs and raise the Series A, and then afterwards nothing, just because the business model or the team or the market are not here.
Okay, great. So what I wanted to do was actually have all of you speak more for the purpose of having everybody understand your perspective and where you're coming from. What I think we should do, and again, I'm really going for a minimum viable panel session, I'm trying to, I got an objective here, which is if you can make use of the contact, and if there's something specific that somebody here can be helping you with, I want you to be able to connect with them. And so what I'm going to suggest is, why don't we take basically 2 questions that you think, the kind of question that you think might be interesting to everybody. And then what we'll really do is we'll basically stop there, and I'll say that if you want to come and follow up with anybody here on the panel, come and have that conversation offline, because I want it to be not just a discussion, but ideally a follow-up conversation and actually make some difference to whatever it is that you're working on. Okay? So, and also to, of course, give you time this afternoon to work on your own projects. So, there's one.
VCs and angel investors here in Silicon Valley only invest in the U.S., or are you seeing a trend towards investing internationally as well? There's a lot of international folks.
That could be you. It could be
I
you.
can
I'm not
answer it,
sure. Both
So
of you?
I can speak from our perspective. So we do early stage, we do true early stage. And that's, of course, the highest risk. So how do you reduce the risk? It's actually by working with the entrepreneurs. So were we to give you money, because we realize that money is a commodity. You can get money anywhere. But to succeed, maybe you need some advice, help, guidance, whatever, mentorship. So if we give you money, you also get our time, and you can ask us to do anything for you, and we will. So that kind of assistance we can only give if you're here. So it may be that you're located elsewhere. You're in Ireland, Russia, wherever. But if you want to move here, great. If you're planning on staying in Ireland, Russia, wherever, we can't invest because we don't think that we'd be able to give you the kind of help that you need.
Okay.
About half of our companies are international. And the dilemma for a VC is that they'll typically only do 2 or 3 investments a year. And so even if you are like a Skype that came out of Estonia, or a Baidu that came out of China, which are billion-dollar return plus things, if a VC even funds a company that's successful internationally, it's not better for them, because then they get more deal flow from an international location and they want to be staying here in the Bay Area. So any VC that's really serious about international investments typically either has an affiliated fund in that region or a partner fund that they're with. But the dilemma is that the density of capital here is so much higher than anywhere else abroad. It's partly why accelerators are nice. So accelerators then become this experimental point. We have half of our companies in the next class are international, and when they come, they'll join Alchemist, and the idea is that in 6 months they're going to see if they can get funded by a VC. And when we position them to the VCs, we don't position them as, if you will fund us, then we'll move here. because no VC will invest, because then because they realize that you're truly an international company. We say these are an American company. These are American companies, they're Bay Area companies, and then if they get funded, guess what? They are. They stay, and they'll be here. So I would say, if
the accelerator is literally the way to convert you into an American company.
to test it,
Yeah.
to test it.
Yeah.
Because if you're truly a global big business, the reality is that there's so much more capital here versus other parts of the world that it might be easier to raise. And if it's not, then you can always go back and try to raise locally.
But if you want to build a local business where you are, then it wouldn't make sense to come here.
Well, it
Then
could.
it wouldn't
Because the dilemma is that if you're building a truly billion-dollar business locally and there isn't the funding sources to support that growth, then you might want to come here to raise the capital. And the reality is that you still want to build a business locally because your whole team is there, but you might, be here to get the capital and then have your engineering team there. That happens a lot, and there's been several billion-dollar businesses that have been built that way.
Okay.
Yeah.
All right.
I was just going to say that I've seen that happen quite a bit as well. Where especially, I do a lot of work with Up West Labs, which is a Israeli Israeli kind of incubator, accelerator, whatever you want to call it.
Job, yeah.
And what they do is they basically go out into Israel. They find they're all Israelis who kind of run the group, but they go out to Israel. They're based in Palo Alto. They go out to Israel. They meet these classes, they call them, of companies, and then they bring them here for a few months, and those companies, grow. And I've seen a lot of those companies do exactly what you said, be here in the United States for a little bit and then raise money here and then stay here. Equally, I've seen companies specifically from Israel, not associated with Up West Labs, come here, but only send their CEO here and leave everyone else in Israel because you can get great engineers, really low cost, and then don't bring them here because they'll get stolen. And so you basically build a company that way, and then you can get bought or what have you. So,
Okay. All right. Great. I know that there's one more, definitely interested question here.
Yeah.
But,
the thing is, the main focus on Silicon Valley was in the last few years software, and it still is kind of software is the main investment topic that's active here. Do you feel like there's a shift happening right now? Is it going in a different direction? And when do you expect that to really emerge as the next thing? Because there is something happening, but it's not really that actively. We see all these wearables and Internet of Things. That's everyone talks about. But the bottom line, if you look across the whole picture of new startups, there aren't that many new wearable startups in comparison to new software startups and platforms and internet e-commerce websites whatsoever.
Yeah.
So when are you going to feel that this is going to actually happen and it's done with software, so we can move over to hardware or go more into hardware than into software? Because hardware has a high risk.
Yeah.
Investments.
I think for sure the capital intensity of software is so much lower, so many more people can do it, that there, with the same amount of money, there can be much more activity. I think this is a question that actually everybody here will have a perspective on. So when do we, do you see it? Is Silicon Valley just going to become software, or will anything else come back? Give us your perspective.
I think it is. I think it already is happening. So we have an IoT accelerator. So Alchemist runs. We have a track, which is an IoT track, which is funded by Cisco. And the strategics have actually. This is an ironic thing because the strategics are moving forward quicker than the VCs. So we have an Alchemist IoT accelerator. It's all IoT companies. We've had, Nest was a $3.2 billion acquisition. That's not a trivial acquisition. That's a fund-changing acquisition, and that's also a psychologically changing acquisition. All the VCs that didn't fund Nest, when they get an IoT company that comes and pitches them, they're like, oh, maybe I'll take that meeting. So there used to be this religious thing that was in the VCs' minds about hardware being low-margin, capitally intensive businesses.
Yeah.
And now you are actually, and so they would just categorically not take the meeting.
Ever
That's
since
shifted. So people take the meetings. The question now is, are people writing checks? And some people aren't, but I assure you that it has already shifted. And if you're interested in doing IoT or anything in the hardware space, one, there's obviously accelerators that are out there that can do the seed capital, but the Series A capital is coming because a lot of those Nest funds, Shasta and others, are now allocating more of their funds towards trying to chase the next Nests.
Okay.
Well,
So
and
I'll come to you in 1 second. I just want to make sure I got it.
Yeah.
So you're speaking to devices, basically, product devices, IoT.
Well, yeah, I think,
Are you, you know,
yeah.
could you respond to either chips or systems, or are there other categories that you see, or is it
Well, IoT is really
software
all
to
of
product?
those things. So I mean, I'm using IoT broadly defined, but really to even enable IoT, it's innovations that are happening at every layer of the network stack is being innovated, and you also are seeing chips also that are being. If you look at the hardware on the hardware space as well. The big issue is just getting somebody to pay for the costs of the BOM of building the products, but that's surprisingly efficient today than it was ever in the past. And there's so many innovations that are happening, everything from 3D printing to real lightweight manufacturing processes. So
Right.
you
and
know,
the fabless semiconductors and so forth.
yeah. So
right.
I am incredibly bullish on hardware. I think there are still conservative, there's still sort of certain VCs that have very religious views about this, but people are getting converted.
Okay, yeah, go ahead.
No, I was just going to say that I think that hardware is I'm also bullish on hardware, but I'm bullish on it in a maybe slightly different way, in the sense that I feel like everyone's moved. Like, you take gaming, for example, right? Like, games companies have historically done pretty well. Console gaming companies have done pretty well. And then these companies moved into mobile, and now these companies are doing immensely well. And they don't have to develop for this really hard, hardware anymore. There's not as much sort of infrastructure costs for them to bear. So now they're developing for 2 different mobile platforms and making just as much, if not more money than they were before. And so the question I have for hardware folks who are out there who are looking to raise is, you need to make sure, what does your hardware do that's different than what is already being done by a smartphone or by a TV or by a tablet or by a wearable device? And are you making that much more of a difference that it really bears investment? And if the answer is yes, then I think people will invest in you. If the answer is, well, we do the same thing as like a watch, but we do it like a little bit better, that's not going to be good enough. You need to sort of either latch onto platforms, like, for example, let's say you make this thing that phones all need. Like, that to me is like incredibly valuable, and I think a lot of people would invest in this thing that every single phone needs. If it truly does need it, and it's going to make the phone that much more powerful, and it's going to make the people who develop applications for that phone develop even cooler things, then people will fund you. But if you're talking about making a wholly different device that's a whole new wearable that tracks steps in a different way, it's just not going to fly. So I think it's being practical about what your widget or hardware can do.
Just the whole economics of it.
Right.
Yeah.
And be practical, that people don't want to spend $400 on a whole different device if they've got a device that kind of does the same thing already.
Like InvenSense for gyrometers or something like that.
Right.
Okay. Comments? What do you see?
I think it's a little bit outside of my area of expertise with technology, so I'll defer to the other.
No problem.
panels.
You're brave enough and smart enough to do that. Good.
So yeah, I think hardware is here to stay. It's not going to go away. Software is here to stay. It's not going to go away. But my abstract view is hardware and software are only vehicles for collecting data, and value lies in data. Period. Because the hardware is just going to get more and more commoditized. Software is only going to get more and more commoditized. If you look at Google, like here I have my Android phone. The hardware is completely commoditized. Google charges nothing for Google Maps, Gmail, whatever. They make all their money off the data. That's where the future lies. It's in monetizing data.
Can everybody be making money only on the data?
No, but I think that it's never a bad option to think about the data aspect first. When you're coming up with your business model, think about how do you monetize the data. That's how I would approach it.
Okay.
Okay. What I can observe from another point of view, which is the very startups, and not the startups that are still financed yet by VCs, is that the sharing economy is really developing in France, like the models you guys created with Airbnb and etc. And even if in France the VCs are not sure that they will monetize this at a certain point through the business model, they know that there will be some kind of consolidation / acquisition at the end of the day. So they are keen to invest in it, and it's quite new as a trend. It's been for the last 2 years.
Okay.
And still life science, because there's some of exciting operations of consolidation and IPOs.
Okay. All right. You're the only one who actually can speak to what's going on there. We have so little ability to test the points you're making. So hopefully we've done the right job of doing the setup. No matter how hard I try, I'm trying to get the time so that you can work on your own projects. But if this session is successful, the goal should be that if you want to go follow up on what's happening at an accelerator and how to get into one, come talk to Ravi. If you want to follow up on crowdfunding, if you want to go into an angel network, if you want to know what to do to get into a few venture capital meetings, everybody is here. So I think this is a chance. Come on down and go and find the right person and have a substantial conversation.
And I'm going to put my business cards here in case I don't have time to connect with everybody. So you guys can email me. Okay.
All right. Thank you.